Good day everyone, my name is Jefferson Natividad and our topic for today is about IT BPM engagements. This might sound simple but it's really important because before contracts are signed and even during the partnership, meeting and talking directly helps avoid misunderstandings. In outsourcing, clear and direct communication is the foundation of trust between a client and a service provider. Here's the big question. Am I protected? Whenever two businesses work together, there's always some risk. That's why contracts exist. A contract is like your shield. It makes everything clear. What work will be done, how it should be done, how problems will be handled, and how both sides are protected. Without it, either side could back out or misunderstand. So the contract is really your safety net. Here's what we'll cover today. First, we'll talk about the client-vendor relationship. Then, we'll go into the IT BPM contract itself, including financials. Finally, we'll cover the regulatory requirements that companies must follow. So basically, relationships, contracts, money, and laws. By the end of this module, we should be able to describe what makes a strong client-provider relationship. It will define by the key terms like SOW, MSA, SLA, and KPI. We will explain the 5 core elements of a contract and know the difference between CAPEX and OPEX. We'll also talk about financials and legal requirements. In short, we'll learn the essentials of how outsourcing partnerships are set up and managed.
Client service provider relationship. Client company is concerned with quality transition of process, ensuring that when process are transferred to the service provider, the quality is maintained or improved. Efficient operation of business function that were once handled in-house, making sure that the outsourced business function are operated efficiently, similar to or better than when they were managed internally. Service provider company is concerned with scope of service. The service provider need to know exactly what service they are expected to provide. How to measure success. They need ways to check if they are doing a good job. Standards of quality. They want to make sure their work meets certain quality standards. The BPM contract. This is a formal agreement where a service provider takes over a pre-agreed portion of the client business operation. Scope of work. The pre-agreed portion of the client business operation is documented in the contract as the scope of work. Master Service Agreement. The IT BPM contract along with all attachments, assumption, and documented agreements is collectively referred to as a Master Service Agreement. Definition is agreement that lays out the general rules and conditions for every project or task service provider doesn't for a client. Main elements. Service to be provided. This section describes exactly what service the service provider will deliver. Performance management issues. Change management. This covers how the service provider's performance will be tracked, how problems will be handled, and how change to the service will be managed. Country law. This part includes the legal rules of the country that might affect the agreement.
Core elements, and this is the 5 parts of core elements. The first one is service to be rendered or provided as documented in the scope of work, like outbound sales calls, inbound inquiries or subscriptions, delivering food or flowers or mails. And number 2 is performance standards expected from the service provider, like service level agreements or SLA and key performance indicators or KPI. This is the handle time and average handle time, sales attainment, customer satisfaction rating, and the third one is timeline of the contracts, start dates, go live, and durations. It is a detailed schedule of when the transitions period starts and when the service providers assumes control of the contracted processes. In terms of type or durations, most contracts are typically multi-year contracts. However, and when deemed most effective, on-demand contracts may also be put into effect. And the next one is cost to the client. It refers to the payment made by the client to the service provider for honoring contractual agreements. And the last one is the other specific operations requirements like who will provide the service, qualification of personnel, location of the operations, outline of reporting procedures, decisions making, and escalation of problems, and legal provisions, non-competitions, and confidentiality.
Okay, the first pricing model is called fixed price. This is when the client and the service provider agree on one set price before the work starts. For example, a fixed price per call or per transactions. The good part here, it's very predictable. For the provider, they already know what they need to deliver and how much they'll get paid. For the client, it's easier to budget because the cost won't change. But the downside, it is not very flexible. If something unexpected happens or changes are needed, it could be risky or not. It's like buying a volume meal in a fast food restaurant. You know what you're getting and how much it costs. But you want to change something, you'll probably need to pay an extra. Now, the second pricing model is time and material. Here, the client pays based on how many hours are worked and what materials are used. This is useful when the project is uncertain or flexible, where it's hard to know exactly how much time or effort will be needed. Sometimes, to make sure costs don't go too high, the client and provider agree on a maximum limit. Think of it like hiring an handyman. You pay for the hours they work and the parts they use. The price can change depending on the situation, but it gives you flexibility to adjust as you go. In a real life, many companies use a mix of both models, fixed price for stability and a time materials for flexibility. Now I'll explain the IT BPM construct. Financial is a simple way. When companies make constructs, there are different types of costs involved, and these are usually grouped into CAPEX, OPEX, process costs, and loaded costs. Let's start with CAPEX. CAPEX stands for capital expenditure. This is the money a company spends on the big things that will help the business for a long time, like buying computers, equipments, or even constructing a new office. Think of it as an investment for the future. On the other hand, OPEX stands for operational expenditure. This is the money spent on the day-to-day operations of the business, like the salaries, electricity bills, internet, and the maintenance. These are regular ongoing costs to keep everything running smoothly. To make it simple, CAPEX is for long-term investments, while OPEX is for daily expense. For example, if the company buys new computers or builds an office, that's a capex. But if they pay monthly salaries or electric bills, that is opex.
So, let's discuss the CAPEX and OPEX. CAPEX is a capital expenditure, creating future benefits. It's occurred when a business spends money to buy fixed assets or add value to existing assets with a useful life extending beyond the tax year, also known as capital expenditure and capital expense. Accounting treatment cannot be fully deducted in the period incurred. Tangible assets are depreciated and intangible assets are amortized over time. In output or throughout, money is spent on inventory falls under capex. In operations, costs incurred for acquiring fixed assets, property, or equipment. Examples of capex: buying computer hardware, acquiring intellectual property assets like patients. So let's proceed to the OPEX, operational expenditure. OPEX is expenses incurred in the course of ordinary business, such as sales, general, and administrative expenses. also known as operating expense, operating expenditure, or revenue expenditure. And accounting treatment, operating expenses are fully deducted in the accounting period during which they were incurred. In output or throughout accounting, the money is spent turning inventory into output, or throughout is OPEX. In operations, costs associated with the operation and maintenance of fixed assets. Example of COPEX: salaries and benefits, maintenance and repair of computer hardware, utilities, rent or business development, and employee engagement expenses. In simple terms, CAPEX is for investment in long-term assets, while OPEX covers the day-to-day expenses of running a business. Components of process costs. Process costs associated with roles, activities, processes, tasks that may be outsourced via the offshoring outsourcing strategy. We have three processes: labor costs, direct costs, and indirect costs. Labor costs. This refers to the total cost a company incurs for employing its workforce. It's a crucial element in the overall process cost, especially when considering outsourcing strategies. So, we have the components of labor costs. Number 1, compensation. The base wage or salaries paid to employees for their work. 2, benefits. Additional non-wage compensation provided to employees such as health insurance, retirement plans, and paid time off. 3, bonuses. Extra payments given to employees often based on performance, company profits, or specific achievements. And the last is incentives. Programs designed to motivate employees to achieve specific goals, which may include monetary rewards or other perks. Direct costs are expenses that can be directly tied to producing a specific product, providing a service, or completing a project. These costs are typically easy to trace and allocate. So we have the three labor costs. Number 1 is employee development. Costs associated with enhancing employee skills and fostering positive workplace relationships. 2. Employee tools or equipment. Expenses for providing employees with necessary tools such as desktop computers and communication devices. Last is coordination and management. Costs for activities like travel, representation, meetings, and workshops to ensure a smooth project. Indirect costs. Indirect costs are expenses that are not directly tied to a specific product, service, or project. They are necessary for the overall operation of a business but are difficult to assign to a particular cost object. We have the two direct costs. We have the infrastructure. Infrastructure includes costs for network, mail, other shared employee services, rental, depreciation, and amortization. And the two is other charge. Includes head office of regional shared costs, allocation, interest costs, and foreign exchange gains or losses.
And now we'll talk about the government regulation. First, the Board of Investment. This helps encourage businesses to invest in the country by giving incentives, but companies must follow the rules to qualify. Second is the BIR. Handles taxes all business must be. And now we'll talk about the government regulation. First is the Board of Investment. This helps encourage businesses to invest in the country by giving incentives, but companies must follow the rules to qualify. The second is the BIR. Handles taxes. All businesses must pay the correct taxes and file documents properly. And third is immigration. Make sure that the foreign workers and investors follow the proper visa and work permit processes. And the DOLE. Protects workers' rights, ensures fair wages, safe working conditions, and proper employees' benefit. And 5 is the Pag-ibig, a government fund where the employees and employers contribute mainly for housing and loans, companies must register and remit contribution. And Philippine Economic Zone Authority manages special economic zone businesses inside these zones get benefit but must follow PEZA policies. And last is the Securities and Exchange Commission. Register companies and monitors them to ensure they are operating legally and transparently. And last is the Institutional and Operational Standard Policies Guidelines. This is basically saying that company needs to have its own set of rules and ways of doing things. This cover everything from how the company is organized, institutional, to how it runs its day-to-day activities operational. These are usually written down as standards policies like no smoking in the office, and guidelines like how to handle customer complaints. Service provider implements own regulation. If the company uses other companies to provide services like IT support or cleaning. Thus, service providers also have their own rules. This means that the main company needs to be aware that these service providers aren't just following the main company's rules but their own as well. So, in simple terms, the image is saying that companies have their own internal rules, standards, policies, and guidelines. And if they use service providers, those providers also have their own rules that need to be considered. It's all about making sure everyone knows what expected and how things should be done within the company and with its service providers.
Let's discuss about Board of Investments, or BOI. BOI in the Philippines is a government agency attached to the Department of Trade and Industry that promotes investment in the Philippines by assisting both local and foreigner investors. It offers guidance, incentives, and support to businesses in desirable economic activities, aiming to boost economic growth and job creation in the country. For example, BOI in the Philippines grants Green Lane certificate to priority projects like the 30 billion pesos heavy sections mill of Candelaria Steel Incorporation to expedite government approvals and processes. This means the BOI helps the company navigate regulatory challenges more efficiently, reducing delays and accelerating the project's implementation and operation. The Green Lane aims to fast-track investment that significantly contribute to the country's economic development. Next is BOI qualification. BOI qualification in the Philippines, companies can register their project with the Board of Investments to receive incentives if their business activity is listed in the Current Investment Priority Plan or IPP, which outlines the government's preferred investment areas. This applies to both local and export-oriented companies, whether they're new ventures or expanding existing operations, provided they meet all other requirements. A business can still qualify for BOI incentives even if its activity isn't in the investment priorities plan, as long as it is export-oriented. If the firm is 60% Filipino and 40% foreigner-owned, it must export at least 50% of its output, while a firm with more than 40% foreigner ownership must export at least 70%. Outsourcing companies like call centers or IT BPO firms are automatically considered 100% export-oriented since their services cater to clients abroad. For example, a US-owned BPO company in Manila providing customer support to American clients qualifies for BOI incentives even if BPO isn't in the IPP. In the Philippines, foreigner-owned companies over 40% foreigner equity can register with the Board of Investments only if their activity is classified as a pioneer project under the ITP, such as high-tech manufacturing or renewable energy. If not considered pioneer, they can still register by being export-oriented, meaning they must export at least 70% of their production. For example, a Japanese-owned electronics company producing semiconductors in the Philippines can qualify for BOI registration if it exports most of its chips abroad, even if semiconductor production is not listed as a pioneer activity. And here the BOI requirements to register with the Philippines Board of Investment. Businesses must submit documents based on their structure. First is DTI registration for sole proprietorship and SEC registration for corporations, branch offices, and regional headquarters. They also need to provide audited financial statements and income tax returns for the past 3 years, if available. A board resolution authorizing a representative a completed BOI application form 501 and a detailed project report outlining the proposed activity. These requirements ensure the BOI can properly evaluate the business for registration and incentives.
Development of special economic zones throughout the country and the very competitive incentives available to investments inside PISA. Special economic zones are embodied in the Special Economic Zones Act of 1995, Republic Act No. 7916, a law passed by the Philippines Congress. The establishments and growth of special economic zones, or SEZ, in the Philippines, along with the investment perks they provide, are rooted in Republic Act No. 7916 or the Special Economic Zones Act of 1995 passed by the Philippines Congress. Promote Philippines investments, extend assistance, registers, grant incentives to and facilitate the business operations of investors in export-oriented manufacturing and service facilities inside selected areas throughout the country, proclaimed by the Presidents of the Philippines as PISA Special Economic Zones. PISA boosts Philippines investments by offering support, registrations, incentives, and streamlined business processes to investors focus on export-oriented manufacturing and services. Qualification: export-oriented enterprises that are found in any of PISA Special Economic Zones. Export enterprises located within PISA Special Economic Zones are eligible for PISA incentives. These incentives aims to promote investments and facilitate the business operations of investors in manufacturing and service facilities that primarily cater to export markets. To qualify, enterprises must be located in a PISA designated zone and engage eligible activities such as export manufacturing, IT service, export, or tourism. July accomplished and notarized PISA application form and anti-grant certificate. This is the official PISA application that must be filled and correctly signed, notarized, and accompanied by a certificate ensuring no involvement in corrupt practices. Corporate profile, including that of parent company if applicable. This provides an overview of your company's background, structures, and key information, and if relevant also includes the same information for its parent company. Board resolution authorizing the filling and the designation of representative. This is a formal decision from your company's board of directors that approves the visa application and officially appoints someone to represent the company in the application process. Securities and Exchange Commission is EC Certificate of Registrations, Articles of Incorporations and Bylaws. If not available, submit draft of articles of incorporations. These are legal documents that prove your company is registered with the SEC and outline its structured rules and purpose. A draft may be acceptable initially if the final versions are not yet available. Data Privacy Law, Republic Act Number 10173, an act protecting individual personal information in information and communication systems in the government and the private sector, creating for this purpose a National Privacy Commission and for the other purposes. Republic Act Number 10173, the Data Privacy Act of 2012 safeguards individual personal information within government and private sector information and communication systems, establishing a National Privacy Commission to enforce and oversee its provisions. Control of communication channels and information systems. Bank must manage their communication and IT systems to guarantee that internal information is reliable, complete, traceable, consistent, properly formatted, and promptly accessible to authorized personnel. Auditing of partnerships subject to consolidations. Banks are required to enable their internal audit teams to thoroughly inspect all operations and units within their consolidated partnerships without any restrictions.